Very good morning, ladies and gentlemen, and thank you very much to the organizers for inviting me to share my thoughts. I'm going to talk about the phenomenal opportunity that India offers in the next couple of decades. This opportunity I have crystallized in what is national bestseller, India at 100, Envisioning Tomorrow's Economic Powerhouse. Readers have resonated with the ideas in the book, more than 80,000 of them since the launch of the book on 1st of August this year. So for investors based here, and especially non-resident Indians, the opportunity is something that comes once in a few centuries. And that's what I want to talk about. I'm sure many of you would have heard about the prediction by Ernst & Young that India will be a $26 trillion economy by 2047. Goldman Sachs estimates that India will be a $50 trillion economy not in 2047 but 2075. India's own think tank, Niti Aayog, estimates that India's GDP will be $30 trillion by 2047. I want to share with you that, as Jeff Bezos often says, we humans have this tendency to overestimate risk and underestimate opportunity. I want to share that in these estimations of the potential growth of the Indian economy, each of these estimations is falling prey to the Jeff Bezos syndrome of overestimating risk and underestimating opportunity. I project India to be a $55 trillion economy in 2047. Now, some of you will wonder, what is it that this prof was smoking while he was writing this book? Whatever it is, it seems interesting. Maybe I want to grab a piece of that. I'm a teetotaler, don't smoke anything. So, wrote this very much in my senses, and I want to share that, what is the economic idea behind this. Before I start, let me give a couple of ideas, a couple of examples to anchor this kind of phenomenal growth. Oftentimes we don't, think about the phenomenal power of compounding, over a 20-25 year period. Let me start by giving you the example of Japan. Japan from 1970 to 1995 grew its GDP 26 times in nominal dollars. Its GDP in 1970 was 220 billion approximately. And by 1995, 25-year period, its GDP had grown to $5.5 trillion. This was the time when Japan enjoyed its demographic opportunity. Second example I want to give you to inspire, the fact that India can register similar growth is China from 1996 to 2021. China multiplied its nominal GDP in dollar terms by 22 times. I'm not projecting a 25 or 26 times increase or a 22 times increase. I'm projecting a 16 times increase in India's GDP because, currently India's GDP is close to $4 trillion. That's what I'm estimating over a 23, 24 year period. Let me get into the brass tacks and explain to you, what is the economic logic underlying this estimation. India has the potential to grow at 8% in real terms, real growth of 8%. If you look at historically from 1991 onwards, India's growth has been 7% on average. So 8% is a push goal, is an ambition, and I think ambition that India should certainly have given the structural reforms that have been implemented over the last 10 years. So 8% growth in real terms. Inflation, I estimate India's inflation over the next 2 decades to be about 5%, slightly less than that, but 5%, we can go with that estimation, and I'll give you the logic for each of these numbers. And importantly, especially for those of you who are sitting here and your friends and colleagues who want to think about investing in India, it could be investing as a retail investor or could be investing as an institutional investor. What matters is the rate of rupee depreciation. Because when you are investing your currency, what you care about is actually not the rupee return, but the return in your currency. And that's why the dollar return. Now, historically, if you look at India's rupee has depreciated on average by 3.5% per annum. There are periods when the rupee is very flat, like it was in the last 2 years. And there are periods when it is volatile, like it has been in the last few weeks. But on average, the rupee depreciates by about by 3.5% since 1991. That's the data. But I'm estimating India's rupee to depreciate at 1%, slightly less than 1% going forward, and I'll explain to you why I believe so. So that's the third key estimate. So instead of 3.5%, which basically is what rate of depreciation that has prevailed in the past, I estimate the depreciation to be less than 1% per annum going forward. So if you put these numbers together, 8% growth in real terms, 5% inflation, 8 plus 5, that is 13% in nominal rupee terms, because nominal is basically real growth plus inflation, right? So, this crowd, I'm sure, understands that very well. So 8 plus 5, 13% in nominal rupee terms. Subtract 1% rate of depreciation because depreciation reduces the value in dollar terms compared to rupees. 13 minus 1 is 12%. And again, this audience actually, I'm sure, uses the rule of 72 day in, day out to actually know the number of years it takes to double your money. At 12% rate of return in nominal dollars, using the rule of 72, nominal GDP in dollar terms multiplies, becomes twice, doubles every 6 years. From 2023 to 2047 is a 24-year period. If GDP doubles every 6 years, how many doublings over a 24-year period? 4 doublings. That's 2 into 2 into 2 into 2, or 2 to the power 4. 2 to the power 4 is 16. So from about 3.5, 4 trillion to actually, multiplication 16 times, that actually is, close to 60 trillion. But let me take you to the exact. So in 2023, India's GDP in nominal dollars was 3.28 trillion, to be precise. Let me approximate it to 3.25 so that we can do the arithmetic here. I'm sure early morning, all of you can do the mental math with me. So 3.25 to 6.5 is the first doubling. 6.5 to 13 is the second doubling. 13 to 26 is the third doubling. And notice the Ernst & Young estimate stops there. So basically they're projecting 3 doublings, not 4. But the fourth one, 26 to 52, basically takes us close to the 55 trillion number. If on the other hand, if you do not account for what I'm going to speak about, the important reason why I estimate the rate of rupee depreciation to be 1%, not 3.5%. If you take it to be 3.5%, then instead of 12% growth, we basically are looking at about 9% rate of growth in nominal dollars. Again, use the rule of 72. 72 divided by 9 is 8. So from 2023 to 2047, 24-year period, 24 divided by 8 is 3. So only 3 doublings. And that is what basically is underlying the predictions by the Ernst & Young. In my opinion, actually, it's an estimation that is internally inconsistent, as I will explain just in a minute. So I'll come to that 8% growth number at the end, but let me spend some time on the 5% rate of inflation and the rupee depreciation of 1%, explain to you, using data and economic logic, why I think that this is the rate of depreciation that will prevail and 5% as the rate of inflation. When you look at India, and when India turns 100 in 2047, the economic history of India will be written, and when the economic history is written, 2016 will be marked out as a seminal year, in India's economic history, because that was the year India implemented the inflation targeting regime. I'm sure, you all investors certainly, track this. So if you look at the average rate of inflation that prevailed in India prior to 2016, the average rate of inflation, had been 7.5%. From 1991 to 2016, close to 7.5%. But post 2016, and as you know, the inflation targeting regime requires the central bank, the Reserve Bank of India, to target inflation at 4% plus minus 2%. In other words, in this band of 2% to 6%. If you look at the data, from 2016 to 2024, the average rate of inflation has been 5%. 7.5% prior to 2016 to 5% after. And this is despite COVID, despite the Ukraine war and the supply side frictions that have resulted, and in an environment where advanced economies, sitting from the vantage point that I have on the board of the International Monetary Fund, I get to see this, day in and day out. Advanced economies have faced anywhere between 2.5 to 4 times their historical average inflation, while India has had, 90% of its historical average inflation. So 7.5% to 5%, the inflation targeting regime has played a critical role in that. Therefore, going forward, 5% is a very reasonable expectation for inflation, for India going forward. As I said, in that 2% to 6% band, 5% is certainly on the higher side. So it's a conservative assumption. Now let me explain to you why I think the rate of depreciation of the rupee vis-a-vis the dollar will be 1% and not 3.5% as it has been in the past. For this, it is important to understand a very, a sort of a nuanced conceptual phenomenon, which in my opinion actually, neither Goldman Sachs nor Ernst & Young have actually, have taken into account. When you look at the rate of depreciation of a currency, the rate of depreciation, nominal depreciation, depends on the difference in the per capita growth between two countries and the difference in inflation, because per capita growth affects your purchasing power, right? Compared to 1991, today India, we Indians have a lot more purchasing power. Imagine actually 30 years back when our parents would have been traveling to Dubai, for instance, they would have thought 10 times about buying something maybe at, at the gold souk here, right? But today when we travel, we don't have to even blink an eye. We can go and buy stuff here in Dubai because our purchasing power has increased significantly because GDP per capita has increased. And going forward, GDP per capita growth will indeed lend to that purchasing power. I'm not getting into that part, but let me talk about the difference in inflation and that, and the impact of that on the currency depreciation. What does inflation do? Conceptually, inflation erodes the value, the purchasing power of your money, right? If inflation is, let's say, 5%, today, if I have 100 rupees in my pocket, I can buy goods and services worth 100 rupees today. But next year, I can buy goods and services worth only 95 rupees because inflation has reduced the value of what I can buy by 5%. In contrast, if you look at the United States, the inflation has been 2%. Why am I considering the United States? Because I'm actually wanting to project the rupee dollar, and that's why the US currency dollar actually matters. So US inflation has been 2% on average. So if I have $100 in my pocket today, in Washington, D.C., I can buy $100 worth of goods and services today, but next year I can buy $98 of worth of goods and services. So while India's currency basically is depreciating at 5%, the purchasing power is depreciating at 5%, the US is only at 2%. Therefore, the currency nominal value has to adjust to keep the purchasing power unchanged, and that is why a currency that faces higher inflation also experiences higher depreciation. This is something that is fundamental, it's very, very important. Higher inflation in the rupee implies higher depreciation of the rupee, as simple as that. And that is because of the erosion in the value of the currency and the currency having to depreciate to keep the purchasing power unchanged. What does this mean then? Go back to what I mentioned some time back, just about a few minutes back. India's inflation up until 2016 was 7.5%. It has declined secularly from 7.5% to 5%, and it will remain at 5%. We are not getting back to that 7.5% inflation anytime soon. Is not happening. We will be at 5%, possibly less than that, because inflation regulatorily cannot go beyond 6%. There'll be some periods maybe when inflation might be slightly higher, but equally there'll be periods when it is less than 4% as well. So on average, 5% is actually a very reasonable expectation. A decline from 7.5% to 5% Everything else held constant, no change. Assume US inflation to be 2%, you assume rate of GDP per capita growth in India, and US, everything the same. A decline in inflation of 2.5% will have an impact on the rate of depreciation, will reduce it from 3.5% to 1%. This is the most important aspect in this room when you are thinking about, when you want to invest your money, let's say it's the dirhams, you basically think about the rate of depreciation, and because, if the rate of depreciation vis-a-vis the dollar is going to be 1%, equally, in dirhams as well, it will actually be similar. So, compared to the past, when you were investing your money in India, you had to factor in 3.5% rate of depreciation. When you were making investments. Going forward, it is likely to be 1%. And by the way, in the book, if you're not convinced just by me giving you these arguments, go and check out the book. I've actually tested this across several 25-year periods. I've tested it across 20-year periods, 15-year periods, and 10-year periods. I've not put it in the book just for brevity, but I have tested it. And what I find is that the model, what I just explained to you fits very well, especially over 15, 20, 25-year periods. In other words, fundamentals, economic fundamentals, indeed do show up over long periods, and that is why rate of depreciation will be 1%. Now, please don't listen to this and say, oh, the prof said at that session, every year it will be 1%. No, that's not what I'm saying. I'm saying on average. There will be periods where it will be higher, there will be periods where it will be lower, but on average it will be 1%. Keep that in mind. I'm saying that in my, don't go and dish on my prediction, basically, later saying, hey, prof didn't know what he was talking about. So, 8% real growth, 5% inflation, 8 plus 5, 13 in nominal rupee terms, subtract 1% depreciation, 12%, 12% rate of growth, rule of 72, GDP doubles every 6 years, 24-year period, 4 doublings, 2 to the power 4 is 16, and that is why from 3.28 trillion to 55 trillion. That is basically, and there you see why, the predictions by an Ernst & Young or a Goldman Sachs is basically not internally consistent. It's as if instead of looking at the entire elephant, they've actually just held to the, to the tail of the elephant and saying, okay, elephant is a rope. Let me spend a few more minutes talking about the 8% rate of growth. This is something, if you have not, got this question, you should get it. Saying, yes, India has grown on average at 7% from a few hundred, couple of $100 billion that we were in 1991 to, about 3.5 trillion now, close to 4 trillion. At growth at 7% from a few $100 billion to a few $1 trillion is fine. But what about growth hereafter? From here on, to 4, 5, 10, 20, can we register that same growth of rate of growth of 7% or even push to 8%, during in other words, what you might have in mind is what we economists think about as the law of diminishing returns. And that is something that should bother you. Actually, if you haven't gotten this question, then maybe you're not engaging with what I'm talking about, as I speak. It is important that you should be asking this question. That's where you should be saying, was the prof indeed smoking something by ignoring the law of diminishing returns? No, this is one aspect that really engaged me. I thought the most about this particular, aspect when writing the book. I wanted to persuade myself first and convince myself first. Only then can I convince anybody else about, the fact that India can grow at 8%. Now, let me go back to the example of Japan that I gave you. Japan, from 1970 to 1995, during that period, its GDP per capita multiplied from $2,100, which is what it was in 1970, to about $44,000, during that period. India's GDP per capita is actually slightly more than, it's about $2,700. So in terms of GDP per capita, the multiplication is very similar. Of course, we have a population that is, Japan's population in 1970 was 100 million. We are 1.4 billion. So obviously, the impact of population actually, will be something. Of course, that means we have to work on social and economic inclusion, jobs, which I've covered in great detail in the book. I'm I don't have time to go through that. But in terms of GDP per capita growth, actually our growth will be very similar to what, what Japan had. So in some sense, therefore, when you think about growth in GDP per capita terms, I'm really not sort of the law of diminishing returns is unlikely to set in, because we're only talking about your GDP per capita increase from about 2,700 to maybe 40,000, slightly more than $40,000 during this period. But let me also give you some key economic drivers why I think 8% growth is something that is obtained. And here, I want you all to sort of, especially those of you who who are investors, who run companies, to start putting on your thinking hats, not just yourself, but with your board as well. Because one of the things I find, actually, as someone who's been trained in the US and has spent a lot of time in India, I find a lot of us, we tend to just mimic the thinking, in the advanced economies. We don't think adequately. Our businesses, Indian businesses, do not think adequately about the right business model to have for India. It's as if we Indians basically do not have the self-confidence to say, we can think for ourselves. Why do we need to why do we need to mimic? And here I will specifically mention, during COVID, and I had the privilege of being at the helm at this point in time, India did something that is absolutely different from any of the advanced economies. None of the advanced economies identified COVID as a supply side shock. India did. And that is why India was the only country in the G20 to actually implement a mix of supply and demand side policies. We had the self-confidence and the courage of conviction to be different from the rest of the world. If the government can do it, I'm sure smart people like you can certainly do it. It's just that mindset, you have to remove that mindset that, it's only the advanced economy people that know. No, it's not, that's not true. They get it wrong too. And this is why it's important to actually contrast growth the way it happens in India vis-a-vis that in advanced economies. When you think about growth, whether it's at the individual level or at the company level, industry level or country level, it happens primarily through two things. One is the rate of investment, how much you invest, and second is what is the return you make on that investment. So for instance, I have a former student of mine here, from ISB, Anish. So when he was thinking about doing an ISB, MBA from ISB, obviously he was investing. But everyone who did an MBA, made the same investment. Maybe each one of them has not enjoyed the return on that investment that Anish has had, because the return on investment was different. So when you think about your own growth, it is basically the investment you make times the return on investment that leads to growth. Same thing is true for countries as well. Macroeconomists use jargon like gross fixed capital formation to GDP, basically investment rate. That is nothing but investment rate, and then they say incremental capital output ratio. These are just scary terms, basically just capturing something as simple as investment rate and the return on capital. Now, when you think about advanced economies, the advanced economies have grown primarily by increasing the return on capital invested, which is basically nothing but productivity. Why? Because these economies have been entirely formalized over the last 5-6 decades. You won't find something, somebody selling in a thela, for instance, coconut water or maybe some, fruits or something. You'll never find it, I'm sure you don't find it in Dubai here either. But you won't find it in the advanced economies for sure. As a result, the investment rate has been mostly stagnant, not much increase in investment rate. Their growth has come primarily from productivity improvements, which itself has come from productivity shocks. If you go and look at, the growth dynamics in the 1990s, the advanced economies grew through the arrival of the internet and online, and internet was that shock, productivity shock that increased productivity. In the 2000s, it was outsourcing to China for manufacturing, to services for India. That's what basically enabled that productivity improvement. And now, there people are talking about generative AI as the next productivity shock that will increase productivity. Now, it is important to understand because advanced economies, they set the frontier. They are the frontier of global business or economic models. In contrast, India's growth will be catch-up growth. Think about this as the frontier. India's growth will be catch-up growth. And that is why, diminishing returns is unlikely to set in, because when you have frontier growth, you have to push that frontier. When you have to push frontier, you have to come up with new ideas, new ways of improving productivity, and there are only so many ideas basically there. In contrast, India's growth will be catch-up growth, stuff that the advanced economies have already done. We just have to actually go and implement that. And that is why diminishing returns is unlikely to set in. Three specific sources that I want to, sort of flesh it out a little bit, and then there are many others I've covered across 27 chapters in the book. I will not have time to go through that in detail. The three key sources are: one is formalization, second, productivity growth in our formal sector firms, and third, credit creation. Using data, I want to back each of these up. If you look at the extent of formalization in the economy, estimates vary because estimating the extent of informal activity is hard. But anywhere between 2/3 to 3/4 of the Indian economy is still informal. I would be very happy if by 2047 India becomes completely formalized. But that's unlikely to happen. India will get very, significantly formalized by 2047. That will affect investment, that will increase investment, and will increase, productivity as well, because formal sector firms are far more productive than informal sector firms. So that will be the first source of catch-up growth. Second source of catch-up growth is just productivity growth in our formal sector firms. If you look at the typical Indian firm, it is about half as productive. Our best firms are half as productive as the American or the German counterparts, or maybe the Japanese counterparts. Maybe the other firms actually will be 1/10 as productive, and these will basically become more productive. And here there's already momentum on this. If you look at the Global Innovation Index, I'm not using government data because sometimes we actually will say, oh, I don't trust government data. If you look at the Global Innovation Index, this is something that is done for all countries. India was ranked 85th in the world in 2015. Now, latest rankings in 2024, India is ranked 39th. 85th to 39th, and that's been the momentum. And of course, if you ask me as an Indian and as an Indian economist, am I happy being the 39th as the 5th largest economy in the world? Of course not. I want India to actually enter into the top 20, top 15, and then maybe the top 10 in terms of innovation. But that momentum from 85 to 39 is something that cannot be ignored, and that will basically lead to productivity growth for sure. Second, if you look at entrepreneurship, and I'm using World Bank data, our counterpart on Pennsylvania Avenue in Washington, D.C., World Bank. If you look at World Bank data, from 2004 to 2014, new firm creation was a trickle at 3.2% from 2004 to 2014. This was the period of policy paralysis, lost decade for India in terms of economic reforms, and new firm creation was a trickle at 3.2%. From 2014 onwards, it's orders of magnitude higher. As a result, India now has the third largest entrepreneurial ecosystem in the world, and more than 120 unicorns now, by far, among the largest. And that is also something that will drive productivity growth, among our formal sector firms, because, entrepreneurship is basically that's why, for me, it's the best indicator of, vibrancy of an economy, because that really, entrepreneurial firms, not only do they become more productive, they push the incumbents also to become more productive. It is as if, running on a treadmill. The existing firms have to continue running to stay where they are, otherwise they end up losing business. So the combination of innovation and entrepreneurship will drive productivity growth in our formal sector firms. And that also will be catch-up growth. I'd be very happy if Indian firms, a bulk of them become as productive as the American or the Japanese or the German counterparts, but unlikely to happen by 2047. Again, diminishing returns is unlikely to set in. Finally, credit creation. Finally, for the purpose of the talk, of course, in the book I've covered judicial reforms, bureaucratic reforms, human capital, all those, as well as sources of growth, but I'm not going to get into that for the talk. But credit creation, here again, if you look at the data, a metric that is quite useful to understand the extent of credit creation in an economy is the ratio of private credit to GDP. Private credit is basically a credit given to individuals, businesses, etc., as a proportion of GDP. If you look at the average for 2020, the global average for private credit to GDP is 150%. And guess what is the number for India? Any guesses? Quite close, 58%. So 150%, 58%. Think about the runway we have there, to grow credit. Phenomenal. And given the public digital infrastructure that India has created, and by the way, that is one thing that all my board colleagues actually really marvel about, on the IMF, including my colleague from the United States as well, marvel about the kind of public digital infrastructure that India has created, which can really enable credit creation in the economy, asset creation, by credit. And that is also something that will actually really help, growth, enable this catch-up growth. Again, I'd be very happy if India becomes, same as the world average by 2047. Unlikely to happen. We'll get there very close. I think my estimate is we'll be about 130, 140% in terms of, private credit to GDP by 2047. There'll still be scope for us to grow. So it's these catch-up growth that can actually deliver 8% growth. And I think, it is really important for me to emphasize. My book is actually emphasizing the potential that India offers. It's as if, think about Sachin Tendulkar in early 90s when he had come about just to, he had hit that wonderful 100 at Perth, much like Yashasvi Jaiswal did, and everyone was raving about it. Sunil Gavaskar was talking about as well, about the potential. I have no pretensions of being a Sunil Gavaskar either in cricket or in anything else, but in a similar way, I'm assessing India's potential, like Sunil Gavaskar assessed in 1993. Sunil Gavaskar made the statement saying, by the time Sachin Tendulkar finishes, if he does not score at least 50 international hundreds and maybe 30,000 international runs, I'll personally go and strangle him. That was basically a statement about the potential. In a similar way, I'm assessing potential. But I think a more important lesson to take from that is that just because Sunil Gavaskar assessed Sachin Tendulkar's potential, Sachin didn't go to score 100 international hundreds and more than 30,000 international runs just by potential. He had to work hard, and I think the Indian economy also has to work hard on reforms, especially at the state level, to ensure that this potential is realized. But if we do, then I have no hesitation in saying that by the time we turn 100, we will be the Sachin Tendulkar of the global economy. Thank you very much. Can take a few questions.
Recently, the Indian economy has slowed down. You think this is a temporary blip, or is it something?
Okay, so let me, I want to mention this, that I'll go back to again, Jeff Bezos' statement that we humans have this real tendency, maybe it comes from our survival instincts, to overestimate risk or overestimate negative aspects and underestimate positives. It's a 1 quarter dip. And tell me one economic variable. I'm sure you track many economic variables. Does each of those variables basically just follow a trend? There are actually blips, and I think next quarter growth will be definitely above 6.5%. I don't have quite likely close to 7%. I don't think this is something that is a permanent blip. And I'll say this with conviction. I don't know how many of you tracked, but when I joined as the chief economic advisor in December of 2018. There were people, including those in the Prime Minister's Economic Advisory Council, economists there, who were saying that basically, growth is, India is already hitting its middle income trap. I remember because of the financial sector problems that I inherited as the CEA, my first quarter of GDP, projections, basically growth was 5.3%. And all my tenure, I had to actually go and defend, some of the things that were done or not done, during my predecessors. But I remember at that time mentioning, if you go check my media interviews, I said there is nothing structurally wrong with the Indian economy, and that we will grow at 7%. And the post-COVID growth has actually indeed illustrated. V-shaped recovery also something that I'd actually predicted, during COVID, and glad to note that actually transpired. So these temporary blips will be there, and I think it is important to recognize that the world is full of cynics, but far too less visionaries. The difference between a cynic and a visionary is that a cynic looks for a challenge in every opportunity. A visionary looks for an opportunity in a challenge. So it's important for us to be visionaries.
Thank you for the excellent session. A lot of people say that last 10 years growth A lot of people say that the last 10 years growth has been a reflection of the Modi government and the kind of reforms they have built in. What is your comment on next 25 years when you say for 2047, we don't know whether the same government will remain or the new government will come. How much impact the government and the policy making will have this impact on the growth? Thank you.
Yeah, good question. Let me, just sort of back up what you mentioned. If you use the Penn World Tables data, this is data that is used, by economists across the world to understand, growth dynamics. If you look at productivity growth in India, from 2002 to 2013, our productivity grew at 1.3% per annum, from 2002 to 2013. From 2014 onwards, productivity growth has been at 2.7% per annum. So 1.3 versus 2.7%. So, and again, this is not government data, this is Penn World Tables data, so actually consistent with what you mentioned. Of course, there's been good reforms, and I think especially the IBC, some of the, some of the schemes like the Jan Dhan Yojana, etc., actually have been really critical. Ayushman Bharat, Swachh Bharat, all these are really important. But what I want you to avoid, Anish, is, what Daniel Kahneman calls, saliency bias. By the way, it's a book that I highly recommend, Thinking Fast, Thinking Slow. Saliency bias, which is that we tend to overestimate the recent observations. The earlier question itself overweighted one quarter dip, in GDP, and ignored in some sense, I'm sorry to actually sort of build on, but previous quarters of high growth, and in fact last year's growth of 8.2%, that is saliency bias for you. I think even when you look at reforms, you're actually, using saliency bias because, maybe you did not, you were younger, but I remember, sitting in the reading rooms of IIT Kanpur and reading about liberalization, in 1991. I was back, I was just doing my engineering there. But do you know that liberalization was done by a minority government? How many of you know here that the liberalization was done by a minority government? And, the highest reforms in a 5-year tenure, was done by which government? Atal Bihari Vajpayee government, which was a coalition. So, the last 10 years of majority government has created this saliency bias in us that it is only a majority government that can actually do reforms. I think that is far from the truth. There is so many low-hanging fruits to pluck that even a government which actually, is a coalition can do reforms. The only point that I will mention, and I think this is something which, we as citizens and actually NRIs and others, we have to highlight is that now the focus has to shift on reforms to be done by states. India is a federal polity, and states unfortunately only focus on their power. They do not focus on reforms. I had the privilege of doing 4 budgets for the union government, and each time after the budget we'd go basically on CII, FICCI, ASSOCHAM, all the others and basically talk about the budget. But these same organizations nor the media does an analysis of any of the state government budgets, but they're actually as important. When was the last time any one of us asks a state chief minister saying, what are the reforms you have done on land? What are the reforms you have done on power? When are you going to stop basically cross-subsidization of free power to farmers, which makes power costly for manufacturing firms? These are questions that we need to be starting to ask, the state governments. That's really critical.
Hi. Your numbers have a lot to do with the future. One question looking from the outside is you didn't mention BRICS, the currency. So is that a real thing or not?
Good question. It's, at this point, primarily a dream. The alternative BRICS currency. I'll leave it at that. Yeah.
Hi.
I just want to make sure that, we're sort of conscious of time. Yeah.
Professor, fascinating talk. Thank you. Look forward to reading the book now. I'm equally bullish. I manage a fund. My biggest concern, which you alluded to in terms of social inclusion, When we meet our portfolio companies, they're very, very bullish in terms of their prospects of profit growth. But almost every discussion involves how they're going to cut headcount, because they're going to automate their factories, they're going to involve AI in services and so on. And we're seeing that in the P&L statements as well. There's hardly any growth in headcount, wage cost as a percentage of top line is declining. So this big demographic dividend which underpins India, if automation is going to disrupt industry after industry, how do we include the people of the country in this growth?
I think that's a very good question. See, this is where I was alluding to. It is important for India and Indian businesses to actually not just copy paste, the business models of the advanced economies. If you think about it, most of the businesses of the advanced economies, they cater to products and services for the top 25-30% of the income pyramid. If you were to draw an income pyramid, right? These are mostly high margin businesses. And that's why, if you think about it, discussions in boardrooms, just implicitly, the questions that a venture capitalist or maybe an investor basically asks is, what's the margin, right? But if you think about it, why is it that the advanced economies focus so much on, on capital intensive, high margin businesses? Because they're labor scarce. In contrast, India actually is not labor scarce. And I think this is fundamentally something that we have to, think about. And so businesses in India need to put on their thinking hats to actually, and here's where organizations like CII, FICCI, and others need to really sort of assemble, bring thinkers together to enable, businesses that are actually, that are going to be, more labor, sort of labor rich. And the reason I say this is because, I don't know if you have heard about this phenomenon called the problem of commons, or the free rider problem, which is, let's say, industry or businesses themselves, by actually going to towards more capital intensive, are effectively hurting themselves. Why? Because every firm on its own, let's say, just thinks for itself, reduces the head count, then overall your employment decreases, and that basically affects your consumption. And eventually your, the industry's prospects are going to be dependent on how aggregate consumption grows. And this is basically what is the free rider problem, that every firm is just thinking about itself without taking into account, what is basically happening in the entire, in other words, this is, problem of commons is always a story of three characters, which is somebody, everybody, nobody. Everybody thinks that somebody else should basically, not cut their employment, and nobody does it. That is basically the problem of commons. But that is why coordination and actually, sort of, and thought leadership at the level of the industry bodies is really critical. India has to have models that are actually that are different. We have to put on our thinking hats, and this, copy syndrome that we actually have had of, copying the advanced economies needs to stop. And I think this is something, I'll give you a couple of examples of businesses that have actually done that. If you look at FMCG in India, right? I'm sure here in Dubai also I don't think you get these shampoo sachets, right? But in India, for instance, when I'm traveling, let's say, even if I forgot to, maybe I'm staying with friends and maybe I don't have my, shampoo bottle or whatever, I can always just, walk across, get a shampoo sachet and use it for the day. And, many times actually the poor end up using these small, volume products and services. Why? Because it caters to the cash flow stream far better. If you think about a laborer or maybe somebody who gets, let's say, weekly wages, right? They get smaller cash flows but more frequently. And that is why the FMCG products, the price points are actually catered to those, to those cash flows. Another example I'll give you, I was on the board of Bandhan Bank, was the founding director of Bandhan Bank, microfinance. Actually, another business that actually where the price points, or in some sense the loans themselves, are smaller so that they cater to the base of the pyramid. In other words, what I'm thinking about is basically, the broad idea I have, and which is something which industry bodies have to fructify better, is high volume relatively small margin businesses. That is an equally good way of actually generating, high dollar profits, right? Why does it have to be that high dollar profits have to come only from, small base, let's say, or medium base multiplied by high margins? You can turn that around and large base India scale, but at India price points. And I think in general, and we were having a discussion, with Anish and I was telling him that, India now needs entrepreneurs, who basically go and create businesses at India scale, at India price points to solve India's problems. That is what really, the next generation, having been part of the government and coming from the private sector, I think it is really important that entrepreneurship basically gets into this, and we put on our thinking hats, not just basically, as I say in Hindi, nakal karne ke liye bhi akal chahiye. So, now we have to actually start doing nakal with akal. You decide. One last question. Okay.
Thanks, Professor, for such an incredible talk. I am Vaidehi here. So, recent years, you have been seeing that there are a lot of, India's household savings has been increasingly getting channelized into equity.
Mutual funds.
Exactly. I mean, equity as an asset class. And this has seen the widening the investor base and also helped in finding the better pricing, right? So when can we use to or expect to use such trend in other markets like bond and currency? And do you think that, retail participation in such markets should be incentivized?
Excellent question. I think we have to make a difference between equity versus bonds. I think equity participation, retail investors actually is something that is very, very good. But I'm referring to another, the first book of mine, if you're interested, actually, is a far more conceptual book. Not that India at 100 is not, but this book is it's titled Money, a Zero-Sum Game. On Amazon, you can go and actually purchase it, where we've talked about, if you think about it, money creation in an economy, who does money creation? If you're thinking, why am I, sort of trying to answer this obliquely? No, I will, I'll sort of connect the dots. See, if you look at what we economists think about as M3, which is basically the supply of money, that's the broad money in the economy, almost 90% of that is basically deposits. And deposits are created by banks when they lend. When you have, for instance, let's say corporate bonds or, at the macroeconomic level, it is nothing but taking money from basically from the left pocket and putting it into the right pocket, which is not necessarily the case with equity. Because equity, it leads to risk taking, generates risk capital far more. And as you rightly mentioned in your question itself, it provides a stable base. Earlier, for instance, maybe 6 years back, if you heard of CNBC, people said, oh, FII is actually exited and that's why the stock market fell, right? Of course, it's a different point. I've always wondered on CNBC when people say, there was selling in the stock market and that's why the stock markets, fell. I find it very, very sort of curious, because for every sell there is a buy. So what does selling mean? But that aside, I think today, for instance, institutional investors, FIIs in particular, do not have that kind of impact. And I think it has provided a resilience that is incredibly important. So as a policy maker, I would actually encourage this even more, especially mutual funds, on the equity side, but not as much on the bond side. Also because, fixed income is something that is far more quantitatively intensive. And retail investors typically do not understand, things like YTM, duration, interest rate sensitivity, those things they don't understand. It's a far riskier product for retail investors. For institutional investors, maybe not as much. And that is why, as a policymaker, I would actually encourage far more participation on the equity side through mutual funds, but not as much on the bond side. Thank you very much.